Hey YouTube, my name is Bowen, and today we're going to be talking about trading with divergence, reliable charting, technical analysis, and trading with divergence. If you like this video, please leave a like in the description down below. Thank you very much. It helps us out a lot. Jumping right into it, we're just going to look at this Cardano chart I have open right here. And I just picked a cryptocurrency, any cryptocurrency, and I opened up onto the 4-hour time frame. Now, when you're charting with divergence, you want to be using a longer time frame. That's your goal. If you're using something like the 30-minute or the 15-minute, it's going to be really inaccurate. And even at the 1 hour or 2 hour, it can be inaccurate, I've found. So I generally suggest using the 4-hour, the 1-day chart. Although I will show you guys some examples. I'm just going to do them off the cuff of 1 hour and 30-minute inaccurate and accurate divergences. But to go over, just to briefly cover what divergence is when the price does one thing and an oscillator does a different thing. So if the price goes up and the oscillator is going down, that's divergence. And there are 4 types of divergence. The first 2 are called regular divergence. Regular divergence is higher highs in price or lower lows in price. So when there's higher highs being made in a price point and lower highs being made in an oscillator, that indicates a trend reversal from up to down. So let's go over to what I have here. I have to find it now. There it is. So higher highs in price. I actually have 2 examples of this and 1 example of everything else. Higher highs in price here, and lower highs in the oscillator. And the higher highs in the price and the lower highs in the oscillator indicate a trend reversal from up to down. You can see this happen in both instances where the price went up here, higher highs, lower highs, and then the price went down just like that. And then same thing here. Let's get that out of the way. The price went up here, the divergence said lower highs, higher highs, and the price went down. So same sort of deal, exactly like that. The second type is simply lower lows in price and then higher lows in the oscillator, which is a trend reversal from down to up. So lower lows in price, we have to find that now. I already drew it on my graph here. There it is. Lower lows in price and higher lows in the oscillator. By the way, I happen to be using MACD and stochastic RSI, but this works on any oscillator or indicator, including volume indicators. You can use it on CMF for accumulation distribution. I do use it on CMF, stochastic RSI, MACD, RSI. Those are the most frequently correct ones, but you can use them on others as well. In this case, I'm using MACD and stochastic RSI. But in this one, I noticed you can see lower lows on the price, and you can see higher lows in the oscillator. And higher lows in the oscillator right here. And then you can see what the price does with that. The price stagnates, flatlines for a little bit, but then indeed does move up. Get out of my way. There we go. Does indeed move up right here, as goes with divergence. And that's our regular divergence right there. So we've covered lower lows and higher highs. The second type is called hidden divergence. So while regular divergence indicates a trend reversal from up to down or down to up, hidden divergence indicates a confirmation of a price trend. So whereas regular divergence says the prices, they're diverging, higher highs in price or lower lows in price, and then it's going to switch, hidden divergence just says it's going to continue. So the first type of hidden divergence we're going to talk about is lower highs in price and higher highs in an oscillator. So lower highs in price and higher highs in oscillator. Let's find it here. There it is. Lower highs in price and higher highs on the oscillator. So right here you can see the general price trend, right? If you look all the way from up here is down, right? And including starting right here, it's still down. And then we see these higher highs, or lower highs and higher highs, and indeed the price does continue downwards. So it's just a continuation of the prior price trend, even though there may have been a small reversal. Essentially, that's what hidden divergence is. And the second one is higher lows in price and lower lows in the oscillator. Let's find the last one that I haven't drawn on yet. There it is. So higher lows in price right here, and we're having lower lows in the oscillator, which does indeed, if you look kind of from down here, or you can look, if you'd like, from over here, the general price trend is up, and this higher lows, lower lows confirms that. Why, you may be asking, and that's an excellent question. The reason why hidden divergence works, and I'll talk about regular after because I forgot to discuss that, is because if the price trend is generally down, right, and you see the price comes up to a higher point but not as high as prior, but the indicator is still rising, when indicators rise, that means that generally the thing is becoming overbought. And so if the price has not come back to above prior levels of price, so the indicator would be matching the price in terms of, if the price was here and then it comes here and the indicator is here and then it comes here, that makes sense. But if the price is not returning to prior levels, that indicates that it's still going to go back down. And as we can see right here, indeed the MACD did go down with this and then rise and had a bullish crossover as it rose back up. The exact inverse is true for our, for our other hidden divergence, right? So our other hidden divergence right here and here, wait, let me clean it up so we can see it a little bit easier, confirms a general upwards price trend, correct? So again, if the price is going up, you can see the price is going on a general uptrend. It just came from a downtrend, but it's in a general uptrend here, starting here. If the price is going up and when it makes a new low, that new low is still higher than the past low, and the indicator indicates a reset. So the indicator has fully reset down to 16-ish, 16-ish regions. That means that the indicator still has a lot of room to move. And indeed, it then did move and it continues to go upwards. Regular divergence is a little bit different, though it's the same general concept. Right here, again, same general concept. The price still managed to make a new high, but the indicator went down. This indicates that it's going to go down. This is actually a clear example. So the price made a new high, but the indicator is going down. That means that it is going to go down rather than a new low. And that's the distinction between hidden divergence and regular divergences. Regular divergence is higher highs and lower lows in price, and lower highs and higher lows in the oscillator, compared to the exact inverse for hidden divergence. So whereas we had higher highs and lower lows in price for regular, we're going to have higher highs and lower lows in the oscillator for hidden. And that's really the distinction between them, and that's what makes them opposites. Now, I talked about I want to go over some reliable charting with divergence, because right now, pretty much what I said is it looks fantastic. But I want to jump over to this Bitcoin graph I've opened and show two instances where divergence did not work. So right here, we have higher lows, right? We have higher lows in price and lower lows in the oscillator. Lower lows in the oscillator, which confirms a price trend which is up. That's what it does. But as you can see here, the price, even at this low, stagnated and then went downwards. So this is actually highly inaccurate. It didn't actually perform correctly as divergence would have said it did. Same thing goes here, another inaccuracy where, and it's not because I'm looking at Bitcoin, these are just happen to be the graphs I had open. But this is a strong lower low and given a weaker higher low, and that's something I want to talk about in a second. But a strong lower low in price and a higher high in the oscillator. Lower low in price and a stronger higher low in the oscillator should indicate a trend reversal from down to up. Well, no. At this point, we can see right here, here is the end point. You can see the trend continue downward all the way to here before then eventually reversing and then evening out that same level that you may have bought in prior. So that would not have been a good entry point. Now, let me talk about the distinction between these two and these four over here. Something, let's talk about, this will also just be a good segue into how to trade well with divergence. So when you look at this divergence right here, this is pretty strong divergence, but you notice right here, this is very weak. It went from 6 to around 2 or 4, which is a very small difference. This is a very tiny divergence, and hence why it didn't work very well. You could argue that it did go down, but it went up that much first. And yeah, that's probably in part the divergence, but it's a tiny divergence. Same thing here, where this went from 228 to around 200. It's a very small divergence for what this is in terms of a massive price decline. In comparison to right here, where we really had a massively different MACD value here as we did here, and a massively different price value as we did here and here. And same thing goes for these ones. So tip 1 for trading with divergence, have large differences between your highs and your lows. Simple as that. So even this would have been risky to trade on because this is such a slight angle. Whereas, again, this one's my favorite because it's so drastic and went up so well. But you can see it's really a massive amount of divergence. The second tip, like I said in the very beginning, is use longer time frames. The longer the time frame you use, the easier it'll be to use divergence. That's all the way over there. So looking at it on a much longer time frame, you're going to find bigger discrepancies, and the discrepancies you're going to find are going to matter a lot more. Like, for example, let's see right here. We have lower highs. I was last drawing with red, that's why it looks that way. But we have lower highs in price and higher highs in the oscillator, which is a confirmation of the price trend, which is down. So let's change this to white, not red. Excuse me. And now we can look at it more clearly and not as incorrect, because indeed the price did continue to go down, and that's where we are today. This video is being made ahead of time for you guys, so this is not the current price. But this is another accurate form of divergence. Compared to if we were to go to the, let's say, 30-minute, because I'm sure it'll be pretty easy to find some divergence on the 30-minute, you're going to see, number one, there's a lot more volatility, and that's, of course, because the indicators are working over time. So we're having right here actually a really great example of lower lows on the price and higher lows in the oscillator, which does indeed lead to a spike. But this is not always the case, as my purpose was actually to come here to show you guys how inaccurate it was. But in general, trading with divergence on lower time frames, although I'm not seem to find an instantly obvious incorrect one, is generally less reliable than is trading with longer time frames. Yeah, I'm having a hard time finding it. But trust me, they're there, and I've seen them before. I remember I've been scalping on a 15-minute chart before and seen divergence. And while you can use it in addition, it is not good by itself. And that's tip number 3 I want to use for divergence, which is use it with other indicators. So, for example, going back to our Bitcoin example right here, if I were to look at, let's see, RSI, and not just use it with other indicators, also use it, there we go, also use it with other time frames. So if I were to look at it here, I would say, well, the MACD was still a little bit high, although not too high. And after I saw that little spike up, I really see the stochastic not moving at all, and I see the price going down here, and the RSI dropping. I would have actually said it was pretty bullish, and it did eventually rise up back to here. And then this should have been my red flag, right? Because you were pretty much, if I entered right here, I'd pretty much be at net zero. But this massive stochastic RSI spike would have been my red flag to get out, right there. Because if it was right there, that was my massive stochastic increase, then that price right there is going to be the final price, and I would want to sell out at that point. Again, looking at different time frames was the other thing I discussed. Oops. There we go. So looking, for example, right here, the stochastic RSI was pretty high and returned lower. And now you can kind of see also how trading with divergence is very helpful, because the stochastic was bottomed out for this entire time period. So when using divergence in the 4-hour, we can get that little tip. But again, looking and seeing that if indicators aren't being accurate, then divergence is not going to be accurate either, because divergence is using indicators in comparison to price. So if we're seeing this right here, this general decline as RSI has dropped out, as stochastic RSI has bottomed out and RSI is dropping, then no divergence is going to be accurate except in a very short term. And if we do want to look at it, for example, on the hourly, I just want to scroll back a bit. If we do want to use it on the hourly, for example, we can see right here we're having higher highs on the oscillator and lower highs in price, which is a confirmation of the price trend, which is down. And indeed, the price trend did drop, but the only reason we would have known that is because of this red candle. So without this red candle, stochastic RSI would have continued upwards. So you wouldn't really have known about this divergence until it dropped, which is why I suggest doing it on longer time frames. So overall, I would really just say, really make sure you're using other indicators in addition to just divergence. Just like any sort of pattern, it's not solely accurate by itself. It has to be used in addition with other time frames and other patterns and other indicators and oscillators as well. If this video helped you with divergence at all, please leave a like below. I appreciate you guys watching. If you want to join the community and learn more about divergence and other indicators, please check out the description below and join our Discord channel. Thank you guys so much. Have a great day.